what happens to your cash value inside your index universal life when you die? Does the insurance company keep the cash value and only pay out the death benefit, or do they combine the cash value to the death benefit and pay both of them out? Well, that's what I'm going to be explaining to you in this video. You see, there's a lot of notion on social media as to what happens to your cash value. There are a lot of financial professionals who don't understand a product, who strongly believe that the insurance company keeps your money and they only pay out the death benefit. But that's due to lack of understanding. Now, the first thing that I want us to understand about insurance is that insurance itself is nothing other than transferring risk from yourself to another entity. So when you look at a life insurance contract, it's simply you saying, hey, when I die, I want you to be able to pay out X amount of dollars to my family. That's risk transfer. Okay. Now, in a product like Index Universal Life, which is very unique, primarily most people who want to leverage the living benefit of it, design it in such a way that they're able to use it while they're still alive. All right. Now, there are two things involved inside this type of product. Number one, you have the insurance company's risk, which is, how much risk they're taking on you. And number two, you have your risk, which is essentially the cash value, right? How much you're bringing to the table in this equation. So we're going to look at an example of a 45-year-old male who primarily wants to get this policy to leverage the living benefit while they're still alive, and whatever is left can get passed on to their beneficiary. So in this example, this gentleman is working with maybe $500,000 because they want to build maybe, retirement supplement or whatever the case may be, right? Now, due to the guidelines in these type of policies, you can't necessarily dump in $500,000 at once, right? In order to do that, that 500 needs to be spread out over a period of time. And you also need a certain amount of death benefit depending on your age and gender to accommodate whatever amount you're trying to dump into it. So we're going to assume, this is a hypothetical scenario, that in order for this 45-year-old male to put in $500,000, which needs to be spread out over the course of, let's say, 5 years, he's going to need $1.5 million in coverage. All right. And then he's putting in, $100,000 every year. So that's a total of $500,000 for a duration of 5 years. Okay. Now, so this is what basically determines the death benefit, all right, or how the policy will perform. Now, the question now is, what is the net amount of risk to the insurance company in this example, right? Because if he has $1.5 million in death benefit, right, and he contributed $500,000 for the sake of leveraging a growth in the policy, how much risk is the insurance company taking on John Doe? Well, the question is, the answer is $1 million. Subtract 500 from 1.5. So technically speaking, the insurance company is only liable for 1 million because he has contributed $500,000 into the policy. All right. So this is what we call self-insurance, which is ultimately what you want in an index universal life. He's self-insured, right? Because this 500,000 is now positioned to earn interest on an annual basis without being exposed to market volatility. All right. Now, with this $1 million, he is now paying cost of insurance on 1 million, not 1.5, because 500,000 technically is his money out of this 1.5. I hope you're following the math so far, but you'll understand it better in a second. All right. Now, because this is a policy that grows over time, what will happen is each year that goes by, this 500,000 will continue to grow and earn interest. All right. Obviously, the cost of insurance is going to be coming out from the 500,000, but it's very minimal because of the way the policy is designed. So now let's say in year 5, okay. Oh no, in year 10 years later. All right. In year 10, this 500,000 now grew to 750,000. This is what the cash value is. So my other question is, what is the net amount of risk to the insurance company if he now has 750,000 in his cash value? The answer is 750. You subtract this from this. So now he's no longer paying cost of insurance on 1 million. He's now paying cost of insurance on 750,000. Now, this is how you get the cost of insurance in your life insurance policy to continue to decrease every year. And now this debunks the whole notion that the cost of your insurance increases every year in an index universal life. It does not if it's properly designed and structured. All right. So now in year 15, we're going to say that this 750 has now grown to 1 million. Okay. $1 million. So the question is, what is the net amount of risk to the insurance company? 1 million subtracted from this, the answer is 500,000. That is what is at risk for the insurance company. So what is he paying insurance on? Is it on 1.5 million or 500? The answer is $500,000. So now the cost of insurance every year is reducing until the point where it's almost obliterated. Okay. So in year 15, we have 1 million. And then in year 20, we're going to say we have, just for the sake of this example, 1.5 million. All right. 1.5 million. Now, if you know math, if your cash value has grown to 1.5, your death benefit is 1.5. What is the net amount of risk to the insurance company? Guess what? The answer is $0. So essentially, the cost of the insurance has completely been eradicated, right? At least temporarily, right? Because now the death benefit is 1.5. He's self-insured for 1.5. Right? Now, you know what that means? That means he's no longer paying insurance for the 1.5. But guess what? This money is still increasing because it's indexed to the market and you're benefiting from the upside of the market. And also, you can access this money 100% tax-free according to tax code 7702. So let's assume that in year 25, your cash value went from 1.5 and is now 1,750,000. Okay? So because your cash value is now 1,750,000, it's 250,000 more than your initial death benefit. So what now happens? Your new death benefit now becomes 1,750,000 because your cash value can never at any point in time exceed your death benefit. So once it gets to the point where it equals to each other, and then your cash value exceeds the initial death benefit, this now becomes your new death benefit. So now the question is, what is the net amount of risk to the insurance company? Well, if your initial was 1.5, your cash value is now 250, and now they have to insure you for that additional 250,000. Now you're paying insurance on the 250,000. Okay? You're paying cost of insurance on the additional 250,000. This is how you reduce the cost of insurance to the barest minimum. And guess what? We're talking about year 25. This is he started out at 45. He's now 70 years old. So rather than having your cost increase throughout the whole duration, it's actually decreasing until your latter years. And then it starts to increase just by a little bit, right? Because your cash value exploded. This is what you truly want inside an index universal life, where you're reducing your expenses to the barest minimum and having your money grow tax deferred and accessing it tax free. All right. So when people talk about, well, the life insurance company keeps your money, that's not necessarily true. It's because this is a leveled design policy, meaning we don't want this to continue to increase every year. Because if it does, your cost of insurance is also increasing. This is called self-insurance, right? You are self-insured right here. When you put in 500,000, you are self-insured, which is reducing the cost that you have to pay on the 1.5 million. Okay. Now there's another way to design this, which is called an increasing, policy, right? A leveled policy keeps your death benefit the same until your cash value starts to exceed that amount. But with an increasing policy, right? I'm just going to erase the figures. What happens is that your death benefit starts to increase every single year because of the way it's designed. Now, there's some instances where you will want to start off with increasing, and I'm not going to get into that in this video. I'm going to create another video for that. Now, the reason why you want to do that, start with increasing, is because, maybe you're fairly young, but I'll touch on that in another subject. But ultimately, every policy must be converted to a leveled policy. So if you start out with increasing, you must at some point in time convert it to a level to prevent the cost of insurance from drastically increasing. Okay. So now let's look at what an increasing policy looks like. All right. So you started out with 1.5 million death benefit, and you decided that you want this policy to be increasing. You want your cash value to be added to your death benefit. So what happens is that after year 5, you put in 500, hypothetically speaking, your death benefit now becomes, all right, you add 500 to 1.5, that now becomes $2 million. So now guess what? Instead of paying insurance cost of insurance on only $1 million, like the other scenario, now you're paying insurance on $2 million because your death benefit is increasing. You want the cash value, quote unquote, to be paid out with the initial death benefit. All right. Meaning that you've now just increased the net amount of risk of the insurance company. Well, let's say in year 10, okay, in year 10, your cash value grew from 500 to 750, like in the other scenario. So what does that mean? That means you add the additional 250 to this. You're now paying insurance, cost of insurance on 2,250,000, right? By year 10. If in year 15, this grew to $1 million, okay, that's another 250,000. You add 250 to this. You're now paying cost of insurance on $2.5 million, $2.5 million. Now, it sounds good that your death benefit is increasing, but as someone who's trying to leverage this policy for the tax benefit and the growth, right, being able to leverage all the living benefit, you don't want to be paying cost of insurance on $2.5 million as you get older. You know why? Because as you get older, the cost of your insurance increases due to your age. Okay. In year 20, you now have 1.5 million. All right. You have 1.5 million. So we're adding an additional 500. So this makes it 3 million. $3 million. All right. Now, that means at age 65, you're paying cost of insurance on $3 million. This is extremely high. This is what eats into your cash value. You know why? Because the cost needs to come out from your cash value. That's how the policy continues to sustain itself without you putting more contribution. So if you want your cash value not to implode and last until age 100, you got to make sure that you're reducing you're converting this from an increase into a level policy. So you don't want this at age 65, right? Now you talk about at age 70, right? This is now 2 million. All right, 2 million. That's additional 500. So now you're paying cost of insurance on 3.5 million. Ladies and gentlemen, if you have an indexed universal life policy and at age 70, it's set up as increasing and was never converted to a level, your policy will implode because your cost of insurance is going to be in thousands, extremely high, as opposed to the other scenario that I explained, where your cost of insurance at 75, you're only paying cost of insurance on 250,000, right? Based on the example that I gave. So first scenario, you're paying cost of insurance on 250. This scenario, you're paying cost of insurance on 3.5 million. This is disaster waiting to happen. All right. So I hope that just the little explanation that I've given helps you to understand how the insurance company, they don't keep your cash value, right? It's really how the policy is designed. And if you start out as increasing, where your cash value is being added to your death benefit, at some point in time, right, over the years, you must convert it from increasing to a leveled policy.